The broadcast is now starting. All attendees are in listen-only mode.
Hello and welcome to today's webinar. I'm Nick Zulovich with Auto Remarketing. In today's session, how will the increase in off-lease volume affect used car residuals? We're going to learn more about this topic from Tony Hughes and Michael Vogan with Moody's Analytics. But before we get started, I want to go over a few housekeeping items for today's webinar. Please make sure you've dialed in using the phone number provided in your communication email, or you're able to listen via your PC speakers. We are recording today's webinar, and we'll make that recording and the presentation available to you as quickly as possible. You will be in listen-only mode for this webinar, but we will reserve some time after the presentation for a Q&A session. You can submit your questions at any time through the questions box on the GoToWebinar control panel. And if we aren't able to get to your question in the time we have today, don't worry, because we'll forward it on to Tony, Michael, and the team at Moody's Analytics so they can respond back to you directly via email. And lastly, if you have any problems during the webinar, please click on the hand icon to alert a member of our team. So today we're really pleased to have two of the most knowledgeable experts from Moody's Analytics with us today. Tony Hughes is the Managing Director, and Michael Vogan is the lead auto economist. So let's learn more about how will the increase in off-lease volume affect used car residuals with Tony Hughes and Michael Vogan from Moody's Analytics. Gentlemen, take it away.
Thank you, Nick. It's a pleasure to be with you this afternoon. Today we're going to talk about really the issue, the primary issue that's facing the auto remarketing sector at the moment and over the next year or so, and that is the effect of off-lease volume on residual prices. Today I'm going to cover a lot of the ground. We're going to really do a deep dive into some really, I think, very interesting data that I think can shed a lot of light on this issue and hopefully sort of settle some frayed nerves. And with me today, I'm going to be joined by Michael Vogan, who's one of our leading auto economists, and he's going to really give the kickoff after my brief introduction. So just to clarify before we move on, we work for Moody's Analytics, and this is a separate, or can be considered a separate organization from the Moody's rating agency. So we really, our organization, does a lot of consulting work, modeling work in a variety of different areas in the financial services sector, including insurance and banking and credit risk and consumer forecasting and so forth, and also obviously in the auto space as well. So nothing we say today, has any impact on ratings, and the ratings process is completely separate from our activities. So our background in the auto sector, we've been working in this area for the best part of 2 decades. Our background is primarily in credit risk modeling related to auto finance. So modeling various risks associated with lending money for the purchase of vehicles. We've worked with a large number of different banks who are very active in the sector, as well as a lot of captive auto finance companies, and increasingly those in the insurance and leasing sectors, more broadly defined. More recently, over the last few years, we've been doing a lot of work in CCAR and stress testing related to auto finance, and we've also, and that work has led us into doing a much, a very deep dive into the drivers of residual prices for used vehicles. This is obviously a critical input for lease portfolios, and it's also the way that credit losses on loans are realized. So our experience is very deep. Primarily, our approach is around trying to capture cyclical effects and then basically forecasting under a variety of different stress scenarios. So with that, let's start to introduce the topic of primary interest today, which is the economics of off-lease volume. So we're going to go through some sort of theoretical musings on this topic, and Michael's going to handle that primarily. And we'll also give you a very brief rundown of the current state of the industry. What I'm then going to do is to do a deep dive into the data that is available as part of the Consumer Expenditure Survey and try to uncover some new ideas about the retirement rates of old vehicles. And in our view, this is a critical determinant of the potential price outcomes that may stem from the flood of off-lease volume. And we'll finish the presentation with a Q&A session at the end, so you'll have plenty of opportunity to ask the burning questions that are on your lips. So off-lease volume, let me explain what this chart is. I've labeled this chart the potential off-lease units being released per quarter. So to annualize this series, you would need to multiply it by 4. That's an approximate annualization. So and this forecast in this chart actually is not based on a model. This is just taking lease originations by the term of lease origination and then projecting out the number of lease contracts that will fall due in each quarter going forward. This is based on data from creditforecast.com, which is a joint venture of ours with Equifax. It's based on a census of all Equifax credit files. So the number here, in terms of, we've labeled this as potential off-lease volume. The actual number here, I think that this will be a pretty close projection. So we expect that by 2018, vehicles will be coming off lease at the rate of around 1 million a quarter or around 4 million a year annualized. And this number is very much in accord with some of the figures that have been suggested around the industry. And that seems like a fait accompli. It's baked into the cake that we are going to get these off-lease units. The question, though, that we're going to address today is, what is the potential impact of that on prices? We could frame this question, I think, in 2 different ways. One is that people have been talking about off-lease volume for a few years now, and yet it's had only a very muted impact on observed prices in the wholesale vehicle sector. And so one way you could frame this question is to ask, why is that so? All right, so why haven't prices fallen as expected in the wake of a flood of off-lease vehicles? And then looking forward, are there any silver linings in the clouds that may suggest to us that prices, that it's not necessarily the case that prices have to fall in the face of a substantial amount of off-lease volume. So hopefully through the presentation you will have those questions answered, and with that I'll turn it over to Michael, who will give you some background and some theoretical musings on this question.
Thanks, Tony. So I'm going to begin by describing the auto industry in general, some current trends, and also talking about how we got to the point where off-lease vehicles are concerned in the market. So in 2016, there were 17.5 million new car sales in the United States. The growth in new car sales after the recession and the level in 2016 generated some news reports which fearfully suggested that there could be some sort of overheating in the auto market. And there are a couple of points on the slide on the screen that may suggest that these concerns are a little overblown. So the first point to note is that although the growth in new car sales has been very strong since after the Great Recession, if you look at the growth compared to 2000, it's actually pretty tepid. And that's especially pertinent given that GDP grew 35% during the same time period. Additionally, the population grew 15% during that time. So when new car sales are normalized by the number of new vehicles per licensed drivers, that series actually trends downward over time. And that metric is presented on the right-hand axis of the graph. So when looking at that normalized measure, it hardly seems that the growth in new car sales is unsustainable for some reason in the market. However, related to the off-lease vehicle question is the fact that a lot of the new car sale growth was driven by leasing. So the green line in this figure, which is on the left-hand axis, shows the percent of all auto finance originations that were leases over time. So you can see that during the worst of the recession, 6% of auto finance originations were leases, and that ratio climbed very quickly up to 16% in the beginning of 2016. However, there are signs that leasing is beginning to slow down. That during the course of 2016, that metric fell by 2 percentage points. Now, leasing is a mature product in the market, so you would expect there to be some sort of steady state rate of leasing originations. Looking at the historical series, before 2012, that rate seems to be about 10%. Looking at auto finance lease delinquency rates, as a percentage of total outstanding balance, you see that after 2015, that metric has started to normalize back to a higher level. Granted, it's not quite even at 2% yet, so it's still relatively low, but the leasing market does have some more room to normalize, and we would expect that leasing will start to taper off and fall back to that steady state of 10% originations. But considering that the off-lease volume really pertains to leases in the past, we have to ask the question, given all the leases that were originated in the years building to 2016, how will that affect prices in the future when they go into the used car market? And to think through those dynamics a little more clearly, we're going to go through some basic economic theory of a hypothetical used car market in equilibria that's hit with a shock of off-lease vehicles. So on the screen right now, the solid green line is the demand curve in that equilibrium used car market, and the solid orange line is the equilibrium supply curve in that hypothetical market. So Q0 is the initial quantity supplied and demanded at P star. Now, when cars come off of lease, what generates the concern is that supply will shift and demand will stay constant. So when the off-lease vehicles hit the market, the supply of used cars will shift from the solid orange line to the dotted orange line S1. Now, if you assume that demand stays constant, it's true that price will fall from the intersection of the solid lines to the intersection of the solid green line and the dotted orange line. However, you have to consider the demand side of the equation when these leases hit the used car market as well. And the salient point there is that the consumer, when they give up the lease, unless they want to walk everywhere or take the bus or get a really nice bike, they will have to buy another car. Right, so in that case, holding prices fixed, that will be a shift in demand as well. So there are three main things a consumer can do at the end of a lease. One is they buy the car that they leased. In that case, that's a one-for-one increase in supply and demand, right? Basic economic theory would hold that every ceteris paribus, everything else held constant, prices shouldn't change in that case. If they choose to buy a used car, that would count as a shift in demand in the used car market as well, further providing a cushion for prices. The last thing they could do is buy a new car. Now, the new car case is a little more complicated because new and used cars are imperfect substitutes, but nevertheless, they are substitutes. So we'll talk about that a little later, but upward price pressure on new cars should create upward price pressure on new cars as well. So the point about this analysis is that the relative magnitudes of the shifts in supply and demand when the off-lease volume dump happens into an equilibrium market, that's what's ultimately going to determine the movement in the price of used cars. Now, it's entirely possible in this analysis that prices could fall or rise. It's highly contingent upon production responses from manufacturers and other things. But the point here is that it's more complex than simply just a supply shift in the market, which is going to push down prices. There's a demand component to the off-lease dump as well that needs to be considered. So given that high-level theoretical analysis of an off-lease dump, what is Moody's macro team forecasting will happen to used car prices? So this figure shows the Moody's Manheim used price index forecasts at different vintages of the forecast. And there's a lot of interesting points here that are illustrative of what we're talking about. So the orange line in this figure from 2005 to 2017 shows the actual trend of the Manheim. And then from 2017 onward, that shows our current forecast. The blue line shows our December 2015 forecast of the Manheim, and then the green line shows the December 2014 forecast of the Manheim. Now, the talk of downward pricing pressure from off-lease vehicles has been occurring for some number of years now. And you can see that our 2014 forecast reflected some of that concern. However, comparing that forecast to what actually happened during that time, used car prices continued to grow. In 2015, the forecast was changed, and we've been on trend since. Now, an interesting point about all of these forecasts is at the current time, they all converge to the actual Manheim value. And what that suggests is that in our forecasting models, the fundamental macroeconomic trends are captured very well. So in the long term, prices have been growing, and our forecasts continue to expect them to grow. This growth is about 2% year over year from 2017 onwards. So given the supply and demand discussion we just had, what sorts of microeconomic trends could support such macroeconomic growth in used car prices? So one of the important questions is, what does the consumer do once the lease ends and they give back their car? So an important point regarding that issue is that in economics, individual consumer preferences typically change slowly over time. And what this means is that their consumption patterns typically change because of changes in prices, not changes about what they like or the utility from which they get from certain things. An example of that in another substitute good market is Pepsi versus Coke. Some consumers prefer Coke to Pepsi, so those consumers will choose Coke every single time. But if the price of Pepsi were to drop by 20 cents, sure, they'll deviate to consuming Pepsi for some period of time, but once that price readjusts, they'll go back to Coke. I think that there's a potential analogy to the car market in that substitute effect and changes in price, where during the leasing boom, a lot of people were enticed by very favorable incentives and terms, when in fact, otherwise, they would have been perfectly happy owning 3 to 8 year old cars, right? So although it's possible that people who lease new cars, they continue to lease new cars over and over and over again, there's also a possibility that once the lease market normalizes, like we previously discussed, and those incentives and terms kind of fade away, that they'll revert back to their used car preference, which, as we just saw in the supply and demand equation, would constitute a rightward shift in that demand curve and provide upward pressure on prices. So that's a potential upside risk to the used car market, is that if consumers chose to buy more used cars once this batch of leases dumps into the market, then there would be upward pressure on prices. Another possibility is on the supply side, this issue of retirement, which Tony will speak to more with the empirical data. So vehicles on the road, if they get retired, that constitutes a supply side contraction on the used vehicle space. And there's some concern that cars are getting newer, right? That this new car boom is weighting the age of cars driven on the road towards to be younger, right? Which would slow down that retirement rate and kind of like accumulate supply. But as Tony will demonstrate in a more empirical analysis, we don't see any evidence of that. Meaning that as long as these retirement rates stay fairly high, that will act as a supply constraint, right? Which that supply constraint and then the boost in demand from off-lease consumers shifting to used cars, that will provide upward price pressure. So that's a brief theoretical explanation of what is happening in the off-lease space. And Tony will speak to more empirical data regarding these problems, because ultimately it's the data and the empirics that are going to solve the problem. So.
Okay, great. Thank you, Michael. Yeah, this question, this has really been sort of burning in my mind for the last year or more, and that is, you know, I kept reading articles that were describing the aging U.S. vehicle fleet, and I was also at the same time seeing these headlines that were you know, shouting about the fact that new vehicle sales were at record levels and that leases were out of control and this sort of thing. And so I was trying to find a way to reconcile those two observations. And so I wanted to take a much deeper look at the nature of the vehicle fleet in the US. And to do that, what I did was I took a deep dive into the Bureau of Labor Statistics and their consumer expenditure survey. So just some background. This is a survey, a very big government survey of consumer preferences. It's been going for the past 20 odd years, so since the late 1990s, and it's been collected in a very consistent manner over that time. There are sections in that database that govern vehicle ownership, both in terms of leasing and vehicle rentals, and also in terms of owned vehicles. And in this case, I'm going to focus solely on owned vehicles, just because my sort of reasoning was that vehicles tend to be owned when they're on the eve of retirement. And I'm primarily interested in the question of the rate of vehicle retirement. So in other words, at what rate are vehicles being taken out of circulation from the US? Because obviously that's the other end of the used car pipeline. The front end is new vehicle sales, all right? And the back end is what I'm calling vehicle retirements. Now, vehicles can be retired because they, you know, get totaled in an accident, or because they're clapped out, or because they're mechanically, you know, they're just too old, okay, or because people are just sick of them. And so there's a variety of different reasons why vehicles are retired, and I'm not really particularly interested in that. I just want to consider the rate of vehicle retirement. One thing to consider just before I dive into the data is that you could draw a distinction between what I'd call voluntary retirement. So these are retirements that have a cyclical component to them. So in other words, you know, people have some control over when they decide to, you know, in a sense, end a vehicle's life. But there are also sort of, you know, so it's sort of like forced and unforced retirement. And the point about this is that so unforced retirements may be in some cases cyclical. So if prices fall, then you can get an increase in cyclical retirements. But there's also the the forced retirements, and these are situations where the consumer has relatively little control. So with that in mind, let's have a look at the historical rate of vehicle retirement, and I'll show you the chart. This is sort of the punchline to start with, and then I'll back up and show you how I got to the punchline. So this is the vehicle retirement rate over time based on the consumer expenditure survey. As I said, this is a substantial survey. You know, more than 40,000 people, respondents, are included in the survey. And they just owned, you know, one of the questions they're asked is, you know, what the model year of the vehicle they own is. And based on that model year, I can pull out a distribution of the age of vehicles in the US. Obviously, I'm assuming that the Consumer Expenditure Survey is a representative sample of the US population. But like I said, the data is used very extensively in the academic community and is very well regarded in terms of its statistical properties. So this chart on the screen at the moment is an index. So I've given the base year of 1998, and it's the estimated vehicles retired or due for retirement. So in history, so what I'm doing here is I'm saying that there was a certain number of 2005 vehicles in circulation in 2012, and then there's a certain number of 2005 vehicles in circulation in 2013. One minus the other is an estimate of the retirement rate for that cohort of vehicles. So we then just add them up over time, convert it to an index. What you'll notice from this chart is that the current level of the series has been rising quite rapidly over the last few years. So in 2016, the number was around the 110 level, so about 10% higher than retirements were in 1998. But that series is projected to increase over the next couple of years, 2017 and 2018, even into 2019. And then at that point, the rate of retirement will peak and will start to fall. And part of the message from today's talk is that we anticipate that the rate of vehicle retirements will fall precipitously after 2020. So let's back up, and hopefully you'll get a sense of how I produced this chart from the next series of slides. It is sort of deliberately in sort of reverse order here. So we're sort of reverse engineering this chart from the next few slides. So the next chart shows the annual vehicle retirements by age between 2010 and 2020. So what we're doing here is we're in effect trying to capture all of the vehicles on, when they've just covered their last mile. All right, and calculating the age of the vehicles at that point. All right, we then can add up using forecasts and model-based projections. We can add up all of the vehicles of each cohort that are expected to be retired during this 10-year window, and then calculate the annual retirement rate. So what we find is that if you consider only 13-year-old cars, just over 1 million 13-year-old cars will be retired each year from service in the US, based on projections, that at their heart are calculated using this Consumer Expenditure Survey. So the peak retirement age, you can see there that I've sort of somewhat arbitrarily put in a couple of goalposts at the 11-year mark and the 15-year mark. And it turns out that the retirement rate for vehicles in the US peaks between those two ages. So prior to that, the retirement rate is relatively low. So for 7- and 8-year-old vehicles, they'll be retired at about a 30% lower rate than vehicles in the 11 to 15-year bracket. And bear in mind that I've calculated this chart over that 10-year window in order to make this a through-the-cycle view. Okay, so in other words, obviously recessions and booms will cause variations in the shape of this curve. Okay, but through the cycle, in terms of the underlying life cycle of vehicles, this should be a fairly close representation thereof. And you can see that the total number of vehicles, obviously there's a dwindling pool of vehicles that are available for retirement after that window is passed. And as a result of that, the number of observed retirements tends to decline as the vehicles age by an additional year. So this is the rate of vehicle retirement, and we've got to keep an eye on this 11 to 15-year age window. The next chart shows the relative distribution of the vehicles in the US by age for 2 different years. So what we're saying here is this is the rate of owned vehicles, which doesn't include rentals and doesn't include leased vehicles. So the first 2 or 3 years of this chart are not really worth looking at, okay? And they're not the primary focus of what we're talking about today. I want to concentrate, as I said, on owned vehicles, which is the typical state of vehicles immediately prior to their retirement. So we're not really going to focus on the front end of this curve, but what we want to do is look sort of, you know, at 5 years and beyond, and this is just the relative frequency distribution of the vehicles at these times. So what we notice is that in the US today, or in 2015, which is the most recent consumer expenditure survey, we note that about 5.5% of all of the vehicles on the road were precisely 4 years old, okay, or they were in a model year that was 4 years prior to the date of observation. But moving forward, you'll notice that the effect of the Great Recession, when new vehicle sales basically halved during 2008 and 2009, you'll see that that's now reflected in the 2015 relative distribution. So because relatively few vehicles were born in 2008, therefore there's relatively few 7-year-old vehicles observed in 2015. Okay, and for comparison, I've laid that against the equivalent series as it was observed in 2008, okay, which again, because we're ignoring the front end of these curves, shows what the state of the vehicle market looked like at the end of the boom, basically. Okay, so at the end of the mid-2000s boom, that's really what the distribution of vehicles by age looked like in the US at the time. So there are two main things to take from this chart. The first one is that there's this giant hole. Okay, there's a real dearth of vehicles between 5 and 10 years of age in the US. So there's a substantial number of millions of cars short, in a sense, in that particular range of vehicle age. And the other point to note is that there's a huge number of vehicles that are greater than 10 years old, and they're much more prevalent in society than they were back in 2008. So these charts, and our working hypothesis here is that when that 2015, when the 7-year-old vehicle hole, that will move forward, move down and to the right over time, and I'll show you an example of that progression in a moment. But as that hole hits the peak retirement window, at that point the number of retirements of vehicles will drop precipitously, and as a result of that, the supply conditions in the vehicle market will be very, very different to how they are today. So, just to show you a few more historical charts from this ilk. Okay, here we have 2008 against the year 2000. I can only express this on a shorter time scale because the year 2000 is relatively, is relatively early in the life of the consumer expenditure survey, and as a result of that, older cars are not well represented. So just focusing in on this chart here. So in the year 2000, this was again at the end of a fairly large boom, but we can still see evidence of previous recessions in that blue curve. The blue curve is the one that represents the year 2000. So if we just focus in on this, what we'll notice is that the 1991 recession, you'll notice that there is something of a hole here around the 9-10 year mark, okay, but it's a much lower, much smaller size than the hole that we see in the 2015 distribution, okay. But our reasoning is that this hole is evidence of the 1991 recession, which of course occurred 9 years prior to the 2000 survey being taken. The other point to note here is that the 2001 recession, all right, which occurred, 7 years prior for the 2008 curve, for the green curve, all right, really shows no evidence of any recession, and that's because new vehicle sales held up remarkably well throughout the 2001 recession. And the 2001 recession was also of just generally lower magnitude than both the 1991 and 2008 events. So the point about this is that in 2000, which was on the eve of the previous period of falling used vehicle prices in the 2002-2003 range, so just prior to that, we didn't see this noticeable hole, okay, and as a result of that, prices, had a lot less upward supply pressure, and therefore they were seen to fall precipitously in the early 2000s. Just going forward, this is just showing the last 3 years of observation here. So green now is the 2013 version, and then the blue is the 2014, and orange is the 2015. And you'll see that the hole, okay, is expected to move down and to the right over time. And so the point is that the hole, if you will hit the 11-year mark in about 2019, okay? But that gives us 2 years before that is going to happen. So basically the number of retirements will peak in 2019, and if we were to pull the curtain back on our slide on the total number of vehicle retirements, we would expect that to plummet in 2020 and 2021. So I guess the moral of the story here is that today there is a significant supply silver lining, all right, that's being provided by the lagged effect of the Great Recession on the vehicle market, okay? Durable goods, the effects of these types of cyclical fluctuations can be very long-lasting, and we think that this is an example of that. So over the last few years, there's been a relatively high rate of vehicle retirement. This is an upward supply shock, and as a result of that, some of the off-lease volume effects have been offset. So just to reiterate, so in other words, if we were to pull the curtain back on this chart, we would expect this series to fall back probably to 100 or even 95 in 2021 and into 2022. One of the implications of this, of course, is that leases written in 2017 will face a very, very different supply picture, okay, when a typical 3-year lease becomes due after that period. Okay, so in terms of the effect on prices, again, just in summary, the lack of middle-aged cars. So the way we describe this is that there's a lot of old cars in the market, and there's a relative dearth of middle-aged cars. So it's kind of like there's lots of baby boom cars due for retirement right now, and there's very few Generation X cars, okay? And as a result of that, the baby boomers aren't due for retirement for a couple of years, but when they do, then, that's when the real fury of the market will be unleashed, okay? In the next 2 years, this is like a slow-moving train wreck, and it's very possible to get ahead of these types of trends. And what we would say that today is that you've got about 1 or 2 years left where these types of forces will act to save you from the adverse effects of a large amount of off-lease volume. So in general, within the next 2 years, what we would say to this question is that the risks are much more finely balanced than many people in the industry are saying at the moment. So the picture at the moment tends to be towards the excess supply of off-lease vehicles is going to be cause nothing but downward pressure on prices, and we view that definitely as a risk. Okay, there's no doubt about it. One of the problems with forecasting blue skies is that sometimes it rains. Okay, and so it's always tough to forecast, I would give a Pandora forecast that everything is going to be fine in the future. Okay, and we do recognize that there are risks from off-lease volume. But having said that, all right, there is this cushion provided by the high vehicle retirement rate. If that rate goes up more sharply than we anticipate, that would even represent an upside risk to the market. All right. One way that this can manifest itself in pricing is that the price of 7, 8-year-old cars will be well supported, and that can, because they're imperfect substitutes, that can act as a support for the price of 2 and 3-year-old vehicles. But nevertheless, there has been some evidence emerge in the industry over the last 6 months of softness in the price of 2 and 3-year-old vehicles. And what we would say is that there's been a slight shallowing in the age profile of residuals. So, relatively old cars, middle-aged cars, they have very good price support, and 2 and 3-year-old cars have less price support. But ultimately, all cars support the prices of all cars support the prices of all other cars. And so therefore, we would expect the broad industry indices like the Manheim to remain solid over time, and but that doesn't necessarily preclude the possibility of some observed softness in the price of 2 and 3-year-old vehicles. Okay, with that, I'm not sure what the protocol is here. Do we hand back to Nick, and he's going to cover the Q&A process?
Great presentation, both Tony and Michael. A lot of great information there to digest. And again, we are recording today's webinar, and we'll make the a link to the recording as well as the presentation that Tony and Michael have made. We'll make that available to you as quickly as possible after our session today. And if you have any questions, we certainly have some time here to address them. Please use the questions box on the GoToWebinar control panel, as a handful of folks already have. So to get our Q&A segment started, gentlemen, just to kick it off, just what kind of advice would you offer the lessors for 2017 from a supply perspective? How should they kind of make any adjustments to supply side strategy that they might have in place?
Yeah, I mean, I think that's the that's the key question moving forward. I mean, obviously the leases, the cat's out of the bag with the leases that have already been made. So the ones that the lessors can control, the lease that the lessor can control is the next one, okay? And I think that that's a critical point to make. But what I would say is that, we've gone looking for reasons why used vehicle prices have remained solid, and we've identified this silver lining, okay, that's been present and will continue to be present for the next year or two. But what I would say is that, this silver lining definitely has an expiry date, and that expiry date is really in 2019. After, a lot of this retirement that we're talking about is baked into the cake, and really, the cars are clapped out. There's no way to avoid these types of retirement. So it is a true silver lining. But if you go out beyond 2020, and if I underwrite a lease today, a 3-year lease, then that puts me at the start of that window in 2020. And our view is just that, independent of what the producers decide to do, the vehicle manufacturers decide to do, we would say that there is a supply shock down the road, and and so I would be very wary of getting heavily into leasing this year.
And to quickly follow up on that, Tony, the closing portion of your comments there to discuss the perspective of the automakers. If you could just address that portion of the component as well. What the manufacturers, how should they digest this information and plan accordingly?
Yeah, I mean, I think, I mean, like I said, I mean, our forecast is that this year new vehicle sales will be roughly in line with where they were last year. I think our forecast is for another very slight record new sales number for 2017, but basically a flat line from 2016 and 2015. And after that, we would expect the market for new vehicles to cool somewhat, based on our forecast. And that would be, so, in terms of, new vehicle sales, I mean, that's certainly where we think that things are heading. In terms of exactly how the manufacturers achieve those sales, I guess the question there is the use of incentives and their effect on realized new vehicle prices. And my history of understanding of incentives is that incentives data are very fickle. Okay, it's very, very difficult to get a strong handle. From a modeling perspective, we've certainly tried, very hard to build useful forecasting models of incentives data. And in general, we find that it's not really particularly amenable to forecasting. Okay, so you know what I mean. I think it's possible to speculate on incentives, but generally speaking, manufacturer incentives are very, difficult to project beyond the very short term.
Very good. That the voice you're hearing, that's Tony Hughes from Moody's Analytics, who's also joined by Michael Vogan of Moody's Analytics as well during our webinar today, entitled "How Will the Increase in off-lease volume affect used car residuals?" And if you have a question for either of these gentlemen, please use the questions box on the GoToWebinar control panel. And certainly several questions have come in, gentlemen, stemming from how you generated the index that you shared in your presentation. Again, you described how the retirement age is often in that 11-year-old to 15-year-old model. Based on the premise that the average current age of a vehicle nowadays is 11 years old, just again, how did you reconcile the retirement rates in your analysis? And again, how are you seeing that older model vehicles in that 11 to 15-year-old range are impacting the value and prices of vehicles in that roughly 3-year-old range that are a fraction of the age?
Yeah, I mean, it's certainly true that the curve that I put on the screen here, I'll go back just for so this curve would be inching more to the right, okay, as time goes by, as manufacturers get better at producing long-lasting, durable, reliable vehicles. All right. So if we were to use a chart, a chart of this series from the, from 2000, let's say, that the peak retirement period would be in that sort of, 9 to 11-year range, maybe. Okay. Part of the reason why I wanted to spread this out over a long time period, you'll notice that I used 2010 to 2020, and because I wanted it to be through the cycle, I didn't want to just get a point in time estimate of the retirement rate. But I did want the central point of the period to be close to where we are today. Okay, and that's why I chose to do this between 2010 and 2020. So it's certainly the case that the retirement age is going to be pushed out over time, and that's going to move very, very slowly. Because part of this is also those voluntary retirements. So the thing is that owning a 15-year-old car, it's just not as exciting as owning some of the new cars that are around today. it doesn't have the same sort of feature set and so forth. And so as a result of that, you know, I think that the physical capability of vehicles is actually expanding much faster than the sort of the consumer obsolescence type story. In terms of the effect of, so the fact that the average age of vehicles is just on the bottom end of that 11 to 15 year range is kind of neither here nor there. They're sort of chasing each other a little bit. So the 11-year rate is going up very, very slowly over time, and I suspect that the window of peak retirement is also going up very slowly over time. In terms of the impact of that on used vehicles, I mean, of 3-year-old vehicles, I mean, our point is really just that, you know, a 7-year-old vehicle and a 6-year-old vehicle are very close substitutes. There are very few 7-year-old vehicles. There are a few more 6-year-old vehicles, but the price of a 6-year-old vehicle must always, you know, all else being equal, must always be higher than the price of a 7-year-old vehicle. And so you've got these sort of dynamic pressures taking place right across that curve, okay? And it's not enough to just say that there's a ton of ex-lease 3-year-old vehicles hitting the market, therefore the price of 3-year-old vehicles will plummet. Because the price of a 3-year-old vehicle can never fall below the price of a 7-year-old vehicle.
Very good, very good. Again, the voice that you're hearing is Tony Hughes from Moody's Analytics, who's joined by his colleague Michael Vogan during our webinar today, discussing on the off-lease market and the impact on used car residual values. And another theme of questions that have come in, gentlemen, is looking from the perspective of the consumer in regards to their efforts to manage their monthly payments and that sort of component of the analysis. And given that the pace of contract terms are perhaps hitting a ceiling that's be it 72 months, 84 months, thereabouts in a retail installment contract, and how do you see affordability playing a role in connection with wage growth and that sort of metric? How might that play some pressure on new car prices, given the constraints that consumers are facing nowadays?
Yeah, sure. So new car prices have been growing faster than wages. Anemic wage growth has been a problem in the economy for quite some time now. With respect to the relationship to financing and leasing options, it's true that there will be some upward pressure in the new car market from repeat new car buyers. These consumers surely exist. And they aren't going to be affected by the extreme ends of financing and leasing options, right? These are probably very high FICO borrowers who have good income and financial prospects. So on that side of the spectrum, you won't see downward pressure. But on the other side, for people on the margin, you would expect to see downward pressure. And the reason for that is that what financing options allow consumers to do is spread their consumption over time, right? So like buying a house, for example, is you front load the consumption of the house, then you pay for it over a longer period of time, and the price for that convenience is interest, right? So consumers on the margin, if the loan terms get to a point where the front loading of that consumption of that new car is more expensive than the monthly payments going out a really, really long time, or whatever other features that the pricing options can't compensate them for, then you would expect to see the substitution effect where we talked earlier, is where rather than buy a new car, perhaps they shift to a slightly used car, right? And that would provide upward pressure to the used car market and a little bit of downward pressure to the new prices in new car markets.
Very good, very good. That's Michael Vogan, who's on our webinar today, along with Tony Hughes from Moody's Analytics. And if we could forward one more slide to number 25, if you've enjoyed and found the information and forecasting useful here in our closing moments that we have left, certainly Moody's offers a lot more products and services to be able to get this information on a more regular basis. The Moody's Analytics Auto Cycle solution is available that offers quantitative, transparent methodology for forecasts, and certainly that tool can be leveraged in your operation, and certainly more information is available via the contact information on your screen at the website economy.com/autocycle. Gentlemen, in our closing moments here of our webinar, and again, that is being recorded, and the presentation and the recording will be made available as soon as possible. You've discussed kind of general trends and that sort of thing. Is there any insight into any as far as cars versus trucks, or any specific vehicle segments that might be more susceptible to change in the overall trends that we've been discussing today during the webinar? I guess if you could, in our couple of closing moments here, could address if you have any insight as far as any specific vehicle segments or any other specifics that could help in the regards to the specific kinds of vehicles that might be impacted.
Yeah, sure. I mean, that's actually a very interesting point because after all, I mean, truck sales are so highly driven by gas prices that in a sense you're going to get holes in the distribution of truck prices in all periods during which gas prices are very, very high. And as a result of that, that would be a very useful way to dig down into the data and to identify other potential supply shadows that exist in the industry. So obviously, you have a truck boom over the last couple of years due to the low gas prices. Back in 2008, or whenever we were in $150-ish oil prices, I can't remember the exact timing, but during that period, you had a recession layered on as well, and truck sales would have been, very, very weak. And so as a result of that, you get these even bigger waves rippling through the truck market. In this case, though, I mean, I did only look at total. I added up trucks and cars for the charts that you see in the presentation today. But that is would be a very, very interesting avenue for future research, and I thank the questioner for that lead.
Very good. That's the voice of Tony Hughes from Moody's Analytics, joined today by Michael Vogan, also of the firm. And if you have more questions for these gentlemen, the contact information is there on the screen, help@economy.com, or can reach out via phone at 610-235-5299. So both Tony and Michael, thank you so much for the great insight and information that you've shared with us today. Certainly a very timely subject matter, and thank you so much for sharing your expertise.
You're welcome, Nick. Thank you.
You're welcome. Thank you.
Well, thank you so very much for joining us.